This is founder of Preservation Specialist Pat Strubbe. I am titling my talk today, Should Your Investment Plan Be Agnostic? Now, I don't know about you, but when I hear the word agnostic, I think of religion. But that term can actually be used in other settings. As you know, I love to read about retirement. One of my favorite authors is Dr. Wade Pfau. In some of his books, Dr. Pfau argues that if someone wants to determine the optimal retirement plan for them, it's a requirement to be agnostic about all the different solutions that are available. Think of it this way. Imagine we're making a huge pot of soup as an analogy for retirement planning. In this scenario, we aim to make the best pot of soup. We have access to all different kinds of foods and spices that we can put into that pot of soup. We may not know which mix will work best, but to have the best chance of making the best soup, we should be willing to consider all the various foods and spices. Retirement planning is similar in many ways. In an effort to find the best retirement plan for you, we should be willing to consider every kind of planning investment option out there. The analogy even allows for all of our different tastes. Just like someone may prefer potato soup to chicken noodle, with retirement, some of us may choose to retire earlier and be more of a homebody, while others may wish to work part-time and travel the world. I'm sure you can think of dozens of ways we all might have different preferences. As we look more closely at attempting to be agnostic in our retirement planning, some philosophies need to be put to the side. Think about if you've ever heard any of the following: that everyone should delay their Social Security as long as possible, that everyone should pay off their house before they retire, or that every married person with a pension should choose the joint payout option. The agnostic retirement planner would never say those things. Sure, delaying your Social Security might be your best choice, but maybe it's not. We think, why don't we run the numbers and see how it looks? So we believe that attempting to be agnostic gives us the best chance to find you your best plan. The same holds true for your investments. You may have heard some of the following before. No one should put money in annuities. No one should have permanent life insurance. No retirees should invest their principal in the stock market, and all mutual fund fees are a ripoff. The religion of investments is real. There are probably more opinions out there than there are people. But if we want to make the best chance of making your nest egg last as long as possible, shouldn't we be willing to consider all the different options? This is on my mind right now because of the spike in interest rates in our country over the last year or so. Last month in my commentary, I mentioned how interest rates have affected the value of real estate and how we believe it could be a great time to allocate towards specific types of real estate. Bonds are another category of investments dramatically affected by the changes in interest rates. If you followed us for any time, we have not recommended allocating to bonds for quite a while. In fact, the last time we recommended bonds was 2008. Someone might argue that doesn't sound very agnostic. But we didn't avoid bonds because it was a belief. We avoided bonds because the Fed dropped interest rates to close to zero, and we didn't feel they had a very good opportunity to perform well. We believe this is proven to be accurate. In fact, in Dalbar's most recent analysis of investor behavior, the average bond investor earned an average of minus 2.31% per year over the last 5 years. Yes, that means the average investor in bonds over the last 5 years lost over 11%. So what has changed? As you know, the Fed has increased rates faster than at any point in history. In fact, rates were higher than they've ever been since 2008. What a coincidence. Since we try to be agnostic, our advisor team periodically reviews the various investment options for you. We believe now is the first time we can generate a solid yield in bond investments in a very long time. In addition, if the Fed starts to lower interest rates, the value of our bond investment could go up. That's a potential combination that we like a lot. I thought it would be wise to announce this to you because you may hear from your advisor in the coming months with suggestions, and they may include bonds. We thought this could help you from being blindsided. Remember, our goal is to help you accomplish all of your retirement goals, and we'll continue to manage your plan agnostically in an effort to do that.